Welcome back to Reimagine 2021. I'm Yonah Hochhauser, and today I'm glad to be joined by Gunnar Jaerv, COO of First Digital Trust. Gunnar, thanks so much for joining us.
Thanks for having me. It's really my pleasure to being here. First time. Excited, really excited.
Awesome. Well, I hope your first time. We hope you have a good time doing it as well, and come back many more times in the future. Now, for some of our guests who might not be familiar with who you are, you want to give some background, kind of who you are and how you got into blockchain?
Sure, I can do a quick introduction. So as you kindly already made a really brief introduction, my name is Gunnar. I'm the Chief Operating Officer for First Digital Trust. And First Digital Trust is a Hong Kong-based licensed trust company. We are actually a spin-off from another trust company in Hong Kong called Legacy Trust. And that's where a lot of my recent background, for the past 10 years has been. Initially, I moved to Hong Kong during 2008, the financial crisis. I set up my own IT firm there, and it's a really long story. But I ended up, meeting the people at First Digital Trust, and my company ended up doing, a number of projects for them, and soon enough, I ended up actually working for First Digital Trust, and the area that I was responsible for was developing some of the internal systems and some of the platforms initially. But for me, it was very interesting what Legacy was doing, and we were always sort of trying to push limits in terms of what technology can do. And also what was really exciting for me was that, trust industry has been around for hundreds of years. Trust companies there's so old trust companies, and there hasn't been much innovation in that space. The banks in the past 20 years, there's been ATMs, there's been internet banking, there's been quite a lot of innovation in the banking. It's been slow, but there still has been, and there hasn't been such a movement in digital assets. Trust space and digital asset space, and that's where back in 2017, 16, and that's where we started looking into blockchain and crypto and digital assets. It was very interesting for us. It was very foreign in a way, but we looked at, even back then, we were sort of seeing potential how assets could be one day issued on a blockchain and transferred. And we started building technology, and we set up a small team, which I ended up leading, focusing on these digital asset projects internally as a sort of a small dedicated team. And that culminated into building out our own platform. What we call is a smart trust platform, which is essentially like an operating system for trust companies, but it's very tightly integrated with some of the features and some of the functionalities that blockchain also provides. And 2019, we finally felt that there is enough momentum, there is enough traction in the industry. The management at First Digital felt that it could be a separate independent trust company, as the business line was very different as well. And that was sort of the beginning story. And that's how I myself, if you ask my background story, I was very long focused, 7+ even more years at Legacy. And that's how I sort of graduated to First Digital and into my current position. And that also, I think, gives a pretty good understanding of how First Digital got started as well.
Mm-hmm. It's really interesting because in the blockchain space, the crypto space, we often hear of trustless blockchains, trustless systems. I wonder how trusts fit into this whole trustless environment. You guys call yourselves the next generation trust company. What kind of future and what value do you see trusts bringing to crypto holders, and what value do you see the blockchain and digital assets actually bringing to trust?
Well, I think when we look at digital assets and crypto and what blockchain can ultimately deliver, we want to end up in a world where we can be completely trustless and everything is automated, everything is decentralized. But until we don't have like mass adoption of digital assets, unfortunately, that's going to be impossible. And until then, you need companies that understand this industry, that are willing to participate and willing to offer and service other startups, other businesses in this space. And a good example of this, I always ask people, and this was, happening a lot in the really early days when there were, everybody was trying to get into digital asset space and buy and sell and trade. So if you have a person in Argentina and person in Hong Kong or China, and maybe the person in Argentina has the Bitcoin and person in China has the money, how can they exchange the Bitcoin for the money without having the intermediary still there, right? There are ways to do it on blockchain, of course, multi-sig wallets and different approaches, but it's really not there in that sense that it's not used widely. And until we have this fiat side still around, there is a need for trusted intermediaries. And where we found our niche is that we invested our time. We got to know the players in the space. We got to know their needs, their sort of language they speak, right? And that has helped us to build a business. And that's what they haven't been getting from banks and traditional financial institutions. Although there has been more adoption in the past 2020 from the bank side as well, I would still say there is a gap between what the traditional financial institutions can do. And I think this space needs companies like us and many other companies that are building sort of new generation financial services with, understanding what the other players, other startups in the space are trying to do, and really trying to help them. Yeah.
I mean, and we see it now. I mean, for so long we've been talking about us in this space have always been saying, when are institutions going to come in? When is institutional money really going to say, hey, this is finally something to take seriously. This is something to look into. There's enough liquidity. There's enough security, because the needs and the worries and the risks to an institutional trader, an institutional investor, is different than the retail. And for the first, let's say, 10 years or so of Bitcoin's existence and the crypto, it's all very, very new, but it was retail. It was, for the most part, people who bought into it early on, who were ideologically believed in it, who wanted to mess around with it, was curious with it, but it was never quite there. And I'd say the ecosystem wasn't quite ready yet for the institutions to come in. Now, you guys obviously deal with a lot of institutions. I believe you guys are Asia's leading digital asset custody provider, if I'm not mistaken. And so you guys obviously deal with institutions a lot. Now, what have you, up until now, when you've been dealing with institutions, what have been the complaints leading up to now that they've had that kind of made them not want to jump in? And what has changed that now the institutions finally are saying, hey, I'm ready to go? Did anything actually change on the ground? Or was it that, hey, they finally saw other institutions going in? So is it kind of like a following the leader and other people went in first? Or did something actually change in the ecosystem that they feel more comfortable?
I think it's a mix of number of things. I would say that one of the underlying themes is AML and compliance. If you look at the traditional financial institutions, everybody that's regulated, they have to follow the rules. And if there are any unknowns, if the regulators haven't made clear their position, or if there are unknowns, or their risk tolerance is not very high, because they can be shut down in a snap of the finger if they do something wrong. So there was a lot of uncertainty, and both in US, in Asia, in Hong Kong, in Singapore, there's been increasing steps in the past year for regulatory clarity. And these steps don't always come in a way a regulator saying, yes, crypto is good and everybody please use crypto. But sometimes they come in negative actions as well, where people that pay attention, you can see which targets or which types of companies regulators are targeting in terms of regulatory action. And you can see, okay, this is maybe not the right way of doing things. That's one thing. And of course, we had in US last year, they announced that banks can custody digital assets, can custody crypto. A few weeks ago or last month in Singapore, DBS, they announced, or it was actually leaked, that they're launching a digital asset crypto exchange. Like a pilot program. And in Hong Kong, the SFC has made it much more clear in terms of what types of funds can deal with crypto, and that has helped. But it has helped a little bit. And there's also different size of institutions. Like if we're talking about top tier banks and top tier institutions globally, I think we're still a little bit far away from a bank publicly offering and offering, let's say, digital asset products to their customers and doing all of that. One of the reasons for that is reserve requirements. As you know, in most countries, governments set reserve requirements, and if banks were to hold or custody digital assets, you know, if you can go up or down 20%, how do you as a bank manage your reserves? That's, you know, these are the questions that really haven't been answered. But you see institutionals, you know, you see like BlackRock allowing Bitcoin in their funds. You see, you know, Galaxy in US getting into this more. And you see traditional companies also, I wouldn't say they're institutionals, but, you know, like big global companies like PayPal and all of them getting in. And these are all good signs. There's still sort of work to do. And yeah, I think it's been a mix in terms of regulations. And there's one more thing, and maybe I'm just sort of going on here, but going back to that regulation side as well. You know, when I said we talk the language of the digital asset companies, that's where the banks really sort of maybe miss their boat or opportunity in some cases. Is that if a digital asset crypto company went to a bank, even if they were the most honest company and had the best business plan and, you know, had the best compliance policies, the banks basically just turned them away because they didn't understand the industry. And, you know, that sort of was driving this negative cycle where companies were setting up these like bank accounts saying they're consulting and IT companies. And when the banks found out, of course, then they shut it down. It was sort of a negative cycle. I think that's sort of fading away. We see now banks being more accepting towards digital asset companies. And I think that's been a positive change as well, that banks are really putting in the effort to understand this industry as well.
Yeah. Well, I mean, yeah, I think that anyone who's, you know, tried holding or connecting bank accounts with crypto, I mean, it's been a massive headache. They historically have, like you mentioned, they don't even bother looking. They just won't accept it. Yeah. They view it as criminal money when, you know, like you mentioned, you could be doing nothing criminal with it, yet they'll gladly take that $1 million of dirty U.S. cash, you know, and they don't know what's behind it either. So exactly right. And I really am excited to see the doors open, you know, let innovation happen, you know, be open, be fair. And you mentioned something interesting about regulation, that the clarity doesn't only come on positive, but also on negative. And we see that with the UK ban on crypto derivatives. Where they essentially made a blanket ban on crypto derivatives to retail investors. And I thought it was so funny because if you looked into it, they actually put out a survey, I believe it was right after or leading up to the ban, where they asked the community members, institutions, whatnot. And overwhelmingly, I think it was over 90% of respondents disagreed with the ban, because of some of the reasons that they gave the ban. They said that the retail users don't understand these complex derivatives, that they lose money on it, and yada, yada, yada. So is this a case of, like you mentioned, where we're learning a lesson where regulators are probably a little more strict when it comes to crypto derivatives than, let's say, just pure custody, holding Bitcoin, allowing Bitcoin on ramps and off ramps?
So it's probably going to be a little bit controversial answer, but I probably fall into that category that would say that crypto derivatives, if not done properly, should not be in the traditional sense available to the retail investors. And if you look at the logic there, you know, derivatives are extremely risky products. There's a huge appeal. There's been all kinds of different exchanges doing crypto derivatives. And if you're not a professional trader, if you don't have that experience under your hood, it's very easy to lose the money. And regulators probably are looking at this from a point of view that they want to protect the retail investors, and they want to avoid companies setting up shop in, let's say, UK and promoting this publicly, while you have another company that's selling as risky derivatives, maybe a bank or broker dealer there, and they follow the more stricter rules. On the flip side, though, I think people that are in the digital asset space, crypto industry, and that really enjoy trading, I think they'll probably gravitate these days towards DeFi products and all of that, where you don't really need, let's say, one centralized entity, running the show. And I mean, there's still ways, to do risky stuff. You can go to different countries, but I think in UK as well, there will be some companies that will take it seriously, that will sort of develop, proper platforms. I don't know whether they will be successful, but there is that risk. And where you have a problem is where you have a massive amount of people going into this space, losing money. Your grandma and your grandpa and your mother and father, and they get bought into this hype, and then the whole industry has to deal with these negative effects again, where there's all these people on TV, for example, saying I lost money and I lost this and that, and I think there's a reason for it, and regulators are there for a reason to protect these retail investors. Yeah.
For sure. I mean, and even looking back a couple of years, at the ICO boom, where I think there was a lot of promise there, but also a lot of people took advantage, or a lot of people were taken advantage of. And that happens. That's not something inherent to cryptocurrencies or digital assets or blockchain. Wherever there's new money flowing in and new opportunities and big returns, there will always be people to get taken advantage of. And I think that did put a lot of a bad taste in a lot of people's mouths, and also made regulators a little wary. And then we have this past summer, DeFi kind of exploded. And you touched upon DeFi a little bit in your answer, and it had some parallels drawn to ICO days. It was this new exciting thing where capital was flowing in, promises of big returns, crazy APYs. But I think with DeFi so far, we've kind of avoided, let's say, it hasn't gone as bad, I think, as the ICO days. I think because it's too complicated. I think, the person who would fall for the ICO scam doesn't even understand how to use DeFi. Doesn't understand how to connect their MetaMask to Uniswap and then do. Yeah. So luckily, I think there is like a barrier of entry that's enough that kind of requires a certain level of understanding to even use. So that is protected. But DeFi does hold a lot of promise, and I wonder, are institutions will it ever go to the point where DeFi is mature enough, the smart contracts are secure enough, they're proven, the institutions will actually say, hey, I could actually, this is lower fees for me to utilize, that this is a quicker settlement, this is whatever it may be. Is there a world where institutions actually use DeFi, or is DeFi for institutions an oxymoron that just can't happen?
I think there's a couple of things that need to happen before they will do it. One of the problems, if anybody's been in a traditional banking industry, you will know this inside out. Banks are very bound into very traditional financial systems. We have this global financial system, and things have been working the same way for 30 years. You have issues like custody. How do you custody tokens? How are the keys handled? How is the security handled? How are the reserves handled? So all of these things need to change in the global system before banks can really go in. And it sort of goes back into that. Like I said, I would not put all the institutions into one bucket. Right? I would consider, let's say, a BlackRock institutional as well. And I would consider, let's say, I don't know, like Citibank or Bank of America institutional, but it's different levels. And it's easier for broker dealers and companies to get into this space as they can sort of, they handle a small piece, but for a large bank, it's difficult. I think maybe in the future, if there's a shift in how the global financial system works and how settlement and clearing systems, have been reformed or revamped, and there is some action going on there within banks and within Europe, and different countries are looking at that and the aspect of custody. Once that gets to a level where you get the banks comfortable and regulators comfortable, I do see investment products being completely automated. And I see DeFi right now, like, it's interesting you brought up the ICOs. So ICOs, was basically 99% of them was just money grab and exit scams, right? People with nice faces on the website collected a bunch of money and then didn't deliver. Essentially, that's what happened here. But DeFi, I see, is like a giant experiment in economics, right? So there's these brilliant people that create smart contracts, create these automated systems and all of that. And the code might be the perfect, but whether the economical aspect there works, that's still a big question. So if there is a big, two big risk areas, I would say. One is the, let's say, the smart contract having some flaw, like a fatal coding flaw. The other is that this is sort of just a nasty creation that, it cannot keep going. But my belief, it's actually the opposite. But nobody knows. But it's a very different thing. I wouldn't say, and like you brought up, I don't think anybody is setting up these DeFi platforms just to scam people. but it's more of an untested experiment basically. And I'm quite excited to see how that's going to work out. But it's it's very interesting, and I see a future where like investments, money movements, all of that is sort of automated and out of the central control, or at least less centralized.
I mean, and also, of course, I mean, it's such a brand new technology. I mean, we're not even like, we're still even in the baby stages. I don't know if we're even born yet. So it still is so early on. And so even the things that we're seeing today, obviously, has been growing pains, smart contract exploits, malicious smart contracts, and all these things. So, I am also, like you, excited to see where the future holds, once capital comes in and once use cases come in. It should be very exciting. Now, one of the, let's say, what started all this, which was essentially Bitcoin and the Satoshi white paper, which really came out of the 2008 financial crisis. And it really came out as a contrast to this, what Satoshi viewed as really a broken financial system. I think a lot of people got excited about it because it was something outside of the set traditional financial world. And one of the, let's say, core tenets, one of the things that allows our current system to function, and not a lot of people think about, is the idea of fractional reserve banking, where people don't realize, or I don't think people think about, when you're putting your money in the bank, they're not just holding it there. They don't have to hold all your money. I think it's in America, it might be 20%. I actually don't know off the top of my head, but their reserves are a fraction of what they have to be. And you mentioned that this doesn't apply to cryptocurrencies. And cryptocurrencies essentially, so far, for the most part, most of the products are, it's there, and you're given a token that represents the token, and that's what it is. And in order for traditional financial systems to even come to play nice with DeFi world or any of these digital assets, they can't pull off fractional reserves.
Exactly.
And so I wonder, if there are clients out there, I'm sure that people would feel much more comfortable keeping their money, knowing that it is fully reserved. And that's obviously, this goes hand in hand with trusts. They want to keep their money where they know the money's secure. And so far, up until now in history, the most secure place was the banks. Is that still the case? Are the traditional banks, if you have wealth, if you have assets, are the traditional banks still the best place to keep those assets safe?
I would say in general, yes. I would say, like, if you have a bank account, you have not much to worry about. But I think there are also some systematic risks there. You mentioned different countries have different reserves. And if I'm not wrong here, US should be about 10%, but you have countries like Japan that should be around close to 1%. And you're absolutely right. The banks don't have the money. And, if you look at the economy right now, 2008 taught us something. And now the COVID, right? It's not a financial crisis, but governments are printing money. The debts are increasing, and there could be systematic risks, and it's very fragile. And in the sort of last financial crisis, 2008, it was some of the bigger investors that also lost money. It wasn't maybe the person with a few $1,000s, maybe as a consequence of the whole downfall, but it was investors that held money with these investment firms that were running Ponzi schemes and all of that. So there is this risk because one moment everything can be good, and in another moment it could be all gone. And if the bank doesn't have reserves, and if the government doesn't come to bail out, there is a problem. And I think cryptocurrencies or Bitcoin or sort of either proof of work currencies, it's very interesting. They can provide that relief, and I think there is a place for it. I think it's just a question of time. I think that idea was so far ahead of it. And people, maybe initially, they had an expectation that, it's going to be like tomorrow, next year it's going to be like Bitcoin is going to be everywhere. And I even remember when I first I was in Barcelona, I was like, I think I was buying a hot dog with some Bitcoin because my Visa card didn't go through on top of the mountain there. So anyways, but people were thinking, okay, it's around the corner. But I see it more as going back in time, and where cars first started coming around, and telling somebody that's been riding a horse for 50 years that we have these cars, and it's going to be a whole different world. Everybody's going to ride a car. They're going to be all electric. Like, you would have sounded like a complete lunatic. And it took maybe like 20, 30 years for that whole transition to happen. And we're seeing another transition right now with, from gas to electric and all of that. It doesn't happen as a snap of a finger. And I think it goes back to the, changing the global financial ecosystem. It takes time. It's sort of a progress. And I don't think people should be discouraged by that. People should have a long-term view of how it started and where we are today, and where it could be. We cannot see the future, but if you look 2008 till now, it's been amazing, right? What kind of services, what kind of products have been built. Even a few years ago, if somebody told you about something like DeFi or concepts like that, it sounded like complete madness. Now it's actually there. And if you wind even further back, then you look at the journey, and it's actually been very interesting deal. Same thing with internet, right? First pages, you had Alta Vista, you had these basic search engines. Some people had imagination, and they thought, but I think nobody really nailed or could have imagined how you're going to have a smartphone in a pocket and you can have a Zoom call with somebody on the other side of the world over the internet. So these are the things, and I think it takes time. It's a gradual sort of a change.
Mm-hmm. I mean, for sure, this is a marathon, not a sprint, and we're very much in the early days. Although I do think that the coronavirus pandemic and kind of the gridlock in terms of travel and the many other side effects has sped it up a bit. And one of the areas I think it did the most, and if we see this looking at the overall economy, if we're taking a big picture of the economy, we've seen, because all the governments have been printing, the majority of governments are printing so much money, there's kind of been a flock of wealth to a supply limited or supply finite assets, like equity markets have skyrocketed. The cryptocurrency market, digital asset markets have skyrocketed. Pretty much any asset right now that you can't just print more of or make more of. We have seen a massive increase in value during this time, and I believe in response to a lot of these governments just printing money. So I do wonder if this is creating another great use case that enabled our blockchain, which is tokenization. Because the problem with a lot of our certain supply finite assets, like physical gold, amongst many other things, and a lot of precious metals, a lot of things, they're great. They're supply limited. They have great qualities that the investors are looking for, but it's hard to digitize them. Is tokenization of assets on a blockchain a real use case that we're going to see grow and grow as time goes on?
Yeah, and I think it's still in very early days, and there's some blockers right now that need to be sort of lifted for this to go mainstream. But there is some exciting stuff happening. Even with us, we have clients that are doing this in the private equity space, sort of private placement space. It's more of a sort of a small circle thing right now. And the main thing is asset tokenization. They're considered securities in most jurisdictions. So you still need to comply with those things, and it's difficult to sell it internationally. But it does provide additional liquidity, and it makes things easier in certain cases, at least on a local level. For me, I think the biggest sort of enabler could be if there is a major exchange either in Europe or US or maybe even Australia or Canada, where you have exchange that gets an approval and they have an access to a big market. I don't think there will be a major sort of breakthrough, I would say, in let's say in Singapore and Hong Kong in that front, at least first. Because you need the market, you need the size, right? And you need an exchange where those tokens could be traded and properly listed and done. So I see that's either coming from US or probably from EU, where you have, a few 100 million, 300 million plus people market access, essentially. But it's happening right now. There are companies that offer, asset tokenization services. I'm not going to name any names here, but, we all know them from US. There is different sort of initiatives and consortiums, both in Hong Kong and in Singapore, to take this to more mainstream. And the consortium approach, I think, is good because it brings together all the different players. So We are, part of some of these consortiums, and what we put to the table is the custody aspect. We can custody traditional assets, the underlying assets that would be tokenized, whether it's real estate or whether it's, an artwork or a painting or I don't know, even like bullion or these assets, right? And we can also custodize tokens. That's another thing. But that's where sort of our expertise ends. And then you have other companies that are, specialized in writing smart contracts. Then you have platforms that enable somebody that don't know how to write a smart contract, create an asset-backed token, and in some cases you need asset managers, you need broker dealers in place as well. And that's where our focus really has been, and that's why it's been mainly tied to private placement and these sort of private offerings or real estate. But I think it's, if we give it a few years, it's going to be there, because the upside is really there, because you have reduced settlement times. You can automate compliance, basically. I would say if this becomes available to retail, lower entry costs and easier entry, basically. I think for issuers, maybe another thing is what we see is the interesting value proposition is that, if you're an issuer or if you have this traditional asset, how do you get access to millennials? How do you get access to the new breed of investors? The Wall Street bets people in a way. Yeah. And they're maybe not on your traditional platforms, or they don't invest into these traditional things. And tokenized assets, I think in a long term are going to be more appealing, because it has that cool factor right now. But it has to be done responsibly, of course. And that's where, when we talked about derivatives and all of that, but it definitely gives you access to the new breed of investors. And there's fractional ownership. You can take an asset that you cannot normally divide, whether it's real estate, property, or gold bullion, and you can fractionalize that. So there are these benefits. I think the timing just needs to be right, and there are companies that are doing this already, but it's like they're too much ahead of their time. There's these other things that need to be sorted out first. Yeah, I think that's sort of my views on tokenization.
Mm-hmm, for sure. Like you mentioned, this fractional ownership. I mean, we're fractional reserve banking. We're not such a fan of, but one thing it doesn't fractional that we do like is the idea of fractional ownership. Like you said, that would open up the markets if you're able to fractionally own art or real estate. Like that would open up to the new investors of the future, which are these the millennials, the subreddit, Wall Street bets, of course. So an overlooked market. That is an overlooked market. And you did mention something I think important: automated compliance, because I think a lot of people incorrectly think that this is a compliance headache. And it's only a compliance headache if the regulation isn't clear. If institutions don't want to come in because they're not sure of the rules. But once the rules are set, if you're using blockchain, compliance couldn't be easier. It's a public chain. It can all be automated. So do you think that institutions are recognizing, and even custodial providers like you guys, recognizing, let's say, the future of compliance? Will there even be a compliance industry once it all could, once it's all on a digital platform, once it's all on a blockchain or something like that, and it all can be automated? Does this change the future of compliance?
So I think there's always going to be two traditional links there. And it sort of relates to the compliance as well. One of the traditional links is that we're still dealing with humans. We're still dealing with people. And even though the tokens are virtual, on the other side, there's a buyer. And there's going to be need for compliance and to verify those identities and to verify those people and to do it efficiently across the borders and all of that. That's not going to go anywhere. And, regulators are going to always ask for that. You got to know who your clients are. And, it's not just taking a selfie, but you got to have an understanding who they are. So there's always going to be an overlap there. But that's not, I don't think that's not something that should be afraid of. There is technology out there. There's interesting solutions, even on blockchain itself, for portable IDs. It's going to take some recognition from the governments to enable that, but all the indicators are showing that it's going in that direction. If we are looking at now banks allowing to open bank accounts, just virtually, all of that, it was completely impossible like a few years ago. So it's going into that direction with that real element. The other element is that, bridges into the real world is that real asset, right? If you're tokenizing gold or if you're tokenizing real estate, somebody's got to hold that asset. And anytime you're holding an asset, whether it's, real estate, gold bar, or cash money, as in, money in a bank or all of that, the regulators will also want to make sure that those are not proceeds of the crime. They're not, involved in terrorist financing and all of that. That's another side of AML that people forget, right? There's always the duality. You have the KYC and AML. And AML doesn't always mean that you always have like a bad element or a drug dealer trying to launder money, but there's all of these, government rogue elements, all of that. And I don't think there can be a system where, like company like us or a financial institution can just take money from anybody without doing those checks. So this is the bridge to the traditional world. And as long as companies that have to do that and do it properly, there shouldn't be any issues. I mean, this is what we battled with in a good way in the early days. We were like, okay, is this like, it sounds very weird, but once we started understanding that, let's say tokenization is nothing else than, maybe setting up like a fund where you have to KYC the fund members and you have to do all of the same things, but you're not handing them a certificate, or you're not setting up like an online client portal and showing them numbers, their fund units. You're just handing them a token, right? The KYC rules are still the same, and it's really nothing new, and it's not impossible to comply with. I think the only thing is that there is not a single company that can do all of this, right? The whole expertise, and I think that's why the consortium approach right now is sort of quite interesting. You have to work with multiple players to get things done, and if those players, let's say, if you have a custodian, if you have a broker dealer, if you have proper issuance platform, audited smart contracts, if all those players do their role as required by the law and regulations, the tokens are not illegal. They're not bad in that sense. It's not that, the fact it's a token that there's, missing KYC or something like that.
It's a tech neutral. It's how other people use it decides whether it'll be bad or good. I'm also a believer in that. Now, within, like you mentioned, there is many different players that are necessary to kind of create this ecosystem. And being a custodian, what people look for in a custodian is security. I'd say mainly, for most people, mainly security. And then I'd say next is convenience and accessibility of funds. And historically, when we're talking about physical assets, historically, what was secure funds? It was, in a vault that was in a bank, guarded by guards, and in a politically secure place. So if you look, Switzerland was historically a banking center of the world. Let's say, I don't think, where people kept their funds because it was politically neutral. Even if there was a world war, you knew that your funds were safe. They had very great privacy rules for their customers. So it was a place that people felt very secure keeping their assets. Now, once these assets are moving to a more digital realm, this whole thing shifts. There's no more real borders anymore. There's more like jurisdictions, but even that with VPNs and whatnot, you can get around. So essentially, location no longer matters. Physical presence no longer matters. It's no longer how many guards you have, but how good is your cybersecurity? How good is your firewalls? How good is your cybersecurity there? And then on top of that, the convenience factor has changed, because it's no longer how geographically convenient is it, but now, how easy is it for me to log in and move my funds? So now that this whole, idea of custody has shifted, as a custodian, how do you guys approach these various different needs of the customers?
So I think the security is definitely still one of the main concerns for our clients as well. But I think we have quite an interesting approach to that. And in our industry, we have been very used to another sort of concept, which is separation of powers. And what that means in the financial space is usually, let's say if you have a broker dealer, asset manager, they don't actually hold the funds. There's, independent custodian to handle that. There are companies like, transfer agents. Every sort of regulated entity has its own role. And this sort of goes back to what I was just saying before, having those players in place. And when we got into this industry with Legacy Trust, one of our first solutions or products was actually a custodial service, basically safekeeping people's digital assets. And that was mainly driven by, basically us just jumping into the industry and looking, okay, where are the problems in this space? What can we solve? And back then you had, hacks pretty much every other week, major hacks and all of that. So we sort of put our heads together and thought, okay, we can actually probably deliver something that's secure if we put in proper internal controls, operating procedures. There was technology out there back then. We used everything off the shelf. Like we had our own proprietary systems, we used Trezors, Nanos, all of that. That was like the super early days, and that's how everybody was pretty much doing their things back then. But then we pretty quickly realized, and we were looking, okay, how are we going to position whether Legacy Trust or how are we going to position our business? And we realized we're not a security company. We are not, company that manufactures hardware. We don't want to set up supply chains to manufacture devices and all of that. And luckily enough for us, around the same time, we met with Ledger, and back then they were building their Ledger Vault product. And we did our due diligence. Ledger back then, I think they had raised about 70 or 80 million euros. They had 200 people, development team in France. Their manufacturing, everything was in France, safe and secure. We were quite happy with that product, and we took a sort of leap of faith, and we rolled out the first Ledger Vault-based custodial solution in Asia. Now there's of course a lot of people using Ledger Vault and all of that, but that solved the problem for us. And it goes back to what you were just also explaining, that it's the same mentality for us, right? Although we don't build a physical vault and hire guards and all of that, which we have for traditional assets still, but for the digital, we go also to the professionals, and we go to the companies that focus on that. So that's how we deliver security to our clients. There's a few other companies as well that we are partnering and using with in that space. So depending on the client needs, if they're more into, like, let's say DeFi, we might have to use a different provider. But that's how we handle security. The other thing is accessibility. What we found very quickly when we got into this space, what doesn't work is crypto just sitting around. Maybe early days you had hodlers and all of that. But if you look at the markets today, it's all about trading, it's all about speculation, all of that. And crypto needs to be accessible. So, a bunker under a Swiss mountain doesn't work, basically, where you have to go and, fetch it, right? So we looked at different platforms and how to make crypto more accessible. And there's been a lot of progress made in that space now. Some of the custodians, they have APIs and systems that make it accessible while keeping it secure. We have multi-party computing now. There's a company out of US doing very good work in that space. Same thing, with some more traditional solutions. It's about providing that cold storage level security, but maintaining the accessibility, because you cannot physically go and make a transaction every time. It's not scalable, and it's not fast enough in this industry. So I think these are the main two sort of keywords that we have seen that are important to our clients. And last one as well is sort of the network effect. So anybody that's holding crypto, they do need access to different services. They tend to hold different other assets. They need access to traditional financial services. They need access to OTC desks, exchanges, all of that. And I think one of the areas where we have been focusing over the past 2 years is building up these relationships with other industry players. Like, if somebody onboards with us, they don't only get custody, they get access to all these other sort of value-added services as well. So yeah, these would be the three items.
Mm-hmm. And like you mentioned, various services. If we're looking, through the eyes, we often speak. I think a problem in the industry is that we often view problems and speak about problems and speak about solutions from the eyes of a crypto user, from the eyes of a crypto insider. And I think if you look at the life or the financial services used by a traditional person or regular everyday person, not in the crypto world. They have their custody where their money is being held in the bank that's sit there secure. They have their purchases, which they might be using by some sort of credit card. but they also have their savings, their investments, which let's say it might be a pension fund, for instance, where there's this third party that is kind of managing their funds and investing it for them for the future. When are we going to start to see, or which is more likely in your opinion? Will it be that the traditional pension funds will say, all right, it makes sense to kind of, have a varied portfolio. So we're going to throw in 1%, 2%, 5%, whatever it may be, some small percentage of digital assets into our existing pensions? Or are we more likely to see the opposite, that people now have the option to kind of build their own pension through DeFi, decentralized things, kind of like Wi-Fi, we're seeing with Wi-Fi, or some of these other digital savings?
Yeah, I think no, traditional pensions are not going to get into this. And the reason for that is I sort of have the behind the scenes view into that whole industry. And the pension industry is probably the most, least transparent, and it's so convoluted and so complicated with so many different asset managers, custodians stacked on top of each other, banks, products being cross-sold and wrapped into insurance and all of this. It's just so complicated. It's crazy complicated. On legacy trust side, we were dealing with private pensions, companies setting up their own company, let's say employee benefit plans and their own company plans. And, we were trying to address some of these, some of these issues and, make pensions also more profitable. Most of the government pensions, they're actually losing money, are not making much money at all, right? And that's why a lot of companies.
That's usually, or right now during coronavirus? You're saying usually government pensions lose money?
Well, not usually, but in a long term, the government pensions, they offer a safety net, but you're not, if you don't make huge contributions yourself, and if you're lucky enough that there are no financial crises and viruses and where people have to dip into their pension savings, at the end of the day, you can have a comfortable life, but this is sort of the old mentality where you work till you're 60 and then you have 20 years left. Maybe you go to travel a little bit and that's it. And, there's so many issues. One of the things, like when we're talking about pensions, the pensions are underfunded because people are living longer. It's not that they don't generate that much yield. They're trying to be safe, but also people are living longer, which means governments have bigger burden. They need to, support a bigger population. We have this financial crisis coming in, and pensions themselves, because they're so convoluted, they're not a very good investment in a way, right? Because they're very conservative and all of that. So if somebody is a little bit more investment savvy, and that's why we were focusing on corporate pension plans, because if you have a corporate pension and the company has incentive basically, and the staff has incentive, and the staff want to contribute into the company pension plan, it's much more simpler. Maybe the portfolio is much more targeted. Maybe if you're working for a tech company, or if you're working for a company that's developing smart cars and stuff like that, maybe that company's pension plan is investing into other companies that are directly benefiting this whole industry. Maybe they invest into chip makers, maybe they invest into battery companies, all of these things. So these types of pension plans tend to be more interesting and well managed, right? Because if you have a government pension plan, it's boring. Banks got a good deal. They get all the population to sign up for it, but there's just huge burdens. And that's why I think the traditional government pensions, all of that is not going to happen. But what I think is going to happen is, yes, corporate benefit plans. Why not? If you're a crypto company, or you're, let's say, a big crypto exchange in US, why not set up a pension plan for your staff where every month part of their salary is contributed in Bitcoin, the other part could be still contributed in traditional assets, and you can have a balanced portfolio. But if we are all right, then this whole crypto thing is going to work out, and in 20 years or 30 years, even that small contribution, even if it's maybe 1 or 2% of the overall portfolio, could yield actually significant returns in that time horizon. And that's why I think these targeted pension plans or benefit plans that companies can set up could be very interesting. And I see crypto being part of that. We've been we did last year also a pilot called BitPension. It was sort of just an experiment. We actually got a lot of interest for that. It was a little bit premature ahead of time, as we really wanted to launch this under First Digital properly, which we're doing now. Actually, we're revamping that, probably looking at later this year. But there is definitely interest there. Like, we got so many inquiries about that, and people are looking to make, even if it's a small monthly contribution into the pension, just to keep and hold it there. So that's, I think those people will be the real hodlers. We won't call them pensioners anymore. We'll call them hodlers in a way.
I like that. I like that. I mean, I like that. Let's get rid of the even idea of pensions and turn them into hodls. And I think we'll all be a better world for it. Thank you so much, Gunnar. That's all the time we have, but I really appreciate, you taking the time and giving us a really interesting perspective, because often I get to speak to the project side. I don't really get to speak to the trust and the custodians on the other end. So really, thank you so much for taking the time. I'm sure our viewers liked it as well. And for all of our viewers here at REIMAGINE 2021, I'm Yonah Hochhauser. Thanks for watching.